There's no easy way to say this, but we're in for a bumpy ride at the end of 2023 and at the beginning of 2024. I have friends and family members that are in careers such as investment advisors, economic professors and specialists, and even bankruptcy lawyers. And every one of them are seeing signs eerily similar to what we saw right before the big crash in 2008. 1 in 2 Americans say their overall financial situation is worse now than it was 4 years ago. That's 50%. An auto loan debt crisis looks like it's brewing super big, which will affect even more people than the housing crisis did back then. Auto insurance rates are rising at the fastest pace in nearly 50 years per Credit News, which means that people are having to pay more for necessities and will have much less money left over for other consumption. When we stop spending on things, then companies stop making money, and when companies stop making money, they stop being able to pay workers, so then they have to do mass layoffs, which puts people further in debt and can't spend even more, which leads to a huge market crash. What other signs are we seeing of a massive crash coming? Applications for unemployment benefits rose by 13,000 to 231,000 recently, which is the most it's been in 3 months. The Bank of Canada has said that the era of very low rates is likely over, so people and firms must adjust. Many real estate experts have been saying this for a while, but this is such a big deal because it keeps people out of the possibility of ever being able to own a home, so they're forced to rent and throw away money each month without building equity. This is also huge because a lot of people chose to buy a house recently at these high rates, figuring that they will drop eventually, and since they're not, people are left with huge financial hardships and will likely default on their house. We're also seeing credit card debt through the roof, showing that people are not saving money or able to pay their bills. Even retirees are coming out of retirement because inflation is too high and they didn't save or invest enough for retirement. The Financial Post reported that employers have seen an uptick in older people applying for entry-level positions. All this being said, there's obviously cause for concern, so here's a quick video on what I'm going to be doing over the next 6 months to make sure and set myself up, and what benchmarks I think everyone should be striving towards to stay safe and survive this turbulent market situation. For those of you that are new to the channel, my name is Nolan Govea and I'm a real live university professor. My students call me Professor G, and I made this channel to make investing simplified. Today's Thanksgiving here in the United States, where I'm located. So if you would take a second and comment down below something that you're thankful for. At times like these, it's so important to express gratitude and to take a second and just think about what we're thankful for. I'm thankful for my amazing girlfriend, my brothers and parents, my friends, the fact that I'm healthy and able to work out, and I'm thankful to God that I'm blessed with this platform to be able to reach you each week and be able to provide my insights and my opinions on investing and personal finance. The Investing Simplified community has been amazing, and earlier this week I was able to give away $1,000 with $100 to 10 people who had fallen on tough times this holiday season, and the types of emails I received from over 200 of you were so heartwarming. And most of you asked not to receive the money, but to give it to someone in more need, which I thought was amazing. So thankful for all of you. Now let's get to the topic for this video. So with all the facts that I shared at the beginning of this video, it's obvious that our economy is not through the thick of it yet. Though we do have an overall positive stock market, this may be a bit of a false positive, and we may be in for a little bit of a decline coming soon. In order to prepare for that, I'm making sure that I have a couple of things in order and set in place before I invest any more money. The people who have these next 4 things set and ready to go will be the ones that will be able to invest the most amount of money and actually take advantage if and when that market does drop. If the stock market does drop as much as people are saying that it might, and you don't have any money to be able to invest in it at the time, then you're going to lose out on one of the biggest chances for wealth accumulation in the history of the stock market. So take these next 4 things very seriously. Number 1 is going to be to make sure that you have an emergency fund of at least $1,000. If you don't have this yet, stop what you're doing and fund this immediately. Things just happen all the time, and you're going to need more than just $50 or $100 saved up. Making sure that you have at least $1,000 will make sure that you won't have to use a credit card to pay off something that just shows up, and then you won't have to pay the interest on that thing because you won't have the money ready yet. Number 2 is to pay off bad debt. Do not invest another dollar until you have all of your bad debt paid off. Bad debt is like credit card debt or anything that has above a 6% interest rate. This one is not fun, I know, but it's going to be one of the most important things you do, especially over this next 6 to 12 months. There's going to be two types of people at the end of this next 12 months or so. Those who have their debt paid off or pay off their debt and stop the bleeding so that eventually they can have a huge investment. And then there's going to be those that at the end of 12 months, they're still going to have to be paying off that credit card debt. And at that point, they're probably going to be paying more in interest than in principal every single month. That'll make it so that you're paying off your credit card balance for years to come and never be able to invest and never be able to reach financial freedom. Credit card debt can be over 20% in interest, which is much higher than most stock market gains could get you. So paying that off is like earning 20% interest in the market. Once you get 1 and 2 done and solidified, now it's time for number 3, which is to now increase the amount of savings that you have. Safety is key during a volatile market. It's much different than what we've seen over the last 10 to 12 years. This next year or so is going to be something that you need to be prepared for, and you need to have more in savings than you had in the past. Now, this step can be somewhat simultaneously done with number 2, but I would weight number 2 much higher. So if you had $1,000 to throw at these things, I would definitely go about $800 into number 2 and $200 into number 3. The goal here is to have multiple months, 3 to 6 months worth of actual living expenses saved up in a high yield savings account. A high yield savings account is just exactly like your regular savings, but they give you a much better interest rate since they have less fees themselves. It's not like the stock market where you could lose some money. If you have $10,000 sitting in a savings account like Chase right now, that Chase account gives you 0.01%. So on that $10,000 over the year, you earn $1. At Capital One, you get 4.3%, which means if you had $10,000 there, you get $430 for free, literally no risk and guaranteed. My favorites are Capital One and Ally, but I did do a video on some super solid ones that I researched, so I'll link to that below so you can watch that at a different time. Once we get to number 4, now it's the exciting stuff. And this is where you want to continue to invest in the stock market. But most people are going to ask, okay, when and how? And that's a great question. First of all, make sure that you've done ample research and you understand exactly what it is that you want to invest in and why. Make sure you're choosing solid and safe funds, because with all of this volatility that it's about to come up, we definitely don't want to take any of your hard-earned money and just gamble it away on something that seems a little too good to be true, because it probably is too good to be true. Specifically for those who have been hearing about this possible recession coming and have been stacking up some cash for a while, I put out this video recently of when to wait and actually invest that huge chunk of money. And even for those of you that don't have a huge chunk, this is still when you should invest. We can all not only survive these next 6 to 12 months, but absolutely thrive and work towards that financial freedom. Happy Thanksgiving to you and your family, and I'll see you on the next video.